Preparing for a Unilever Financial Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Unilever? Unilever appeals to me because finance is closely connected to everyday consumer decisions, from pricing and promotions to supply chain efficiency. I would enjoy turning large, diverse datasets into recommendations that improve profitable growth across well-known brands. The company's global footprint would also expose me to currencies, markets, and different customer behaviors. I am particularly attracted to a role where finance partners with marketing, sales, and operations rather than simply reporting historical performance. While answering, connect your analytical skills to Unilever's global consumer brands, explain your interest in commercial decision-making, and show awareness of the company's scale, purpose, sustainability agenda, and fast-moving consumer goods environment. Question 2. What do you know about Unilever's business model? Unilever sells branded consumer products across categories such as beauty and well-being, personal care, home care, and foods. Its model depends on creating trusted brands, achieving broad distribution, innovating products, and managing price and volume carefully. Revenue is influenced by consumer demand, retailer negotiations, promotions, and currency movements. Profitability then depends on gross margin, advertising investment, manufacturing productivity, logistics, and overhead discipline. Scale provides purchasing and distribution advantages, but complexity increases execution risk. Make sure to cover Unilever's branded consumer products, broad geographic footprint, category diversity, retailer relationships, recurring demand, gross margin drivers, and the importance of brand investment, innovation, pricing, and distribution. Question 3. How would you analyze Unilever's revenue performance? I would decompose revenue into volume, price, mix, foreign exchange translation, and portfolio changes such as acquisitions or disposals. Then I would compare each driver with budget, prior year, and market performance by category, geography, channel, and brand. For example, positive sales growth could conceal declining volumes if pricing increased sharply. I would investigate that distinction because sustainable growth, consumer elasticity, and market share matter more than a headline number alone. In your answer, talk about separating volume, price, mix, currency, acquisitions, and disposals, comparing actuals with budget and prior periods, and linking movements to categories, regions, channels, brands, and management actions. Question 4. What is the difference between gross margin, operating margin, and net margin? Gross margin is revenue less cost of goods sold divided by revenue, so it reflects product economics including materials, manufacturing, and freight. Operating margin deducts operating expenses such as marketing, research, selling, and administration, showing profitability from core operations. Net margin also includes finance costs, taxes, and other non-operating items. At Unilever, commodity inflation may pressure gross margin, while brand investment can reduce operating margin temporarily to support longer-term growth. Be sure to mention the calculation and interpretation of each margin, the costs included, relevant Unilever drivers such as commodities and advertising, and why analysts use margins to assess efficiency and profitability. Question 5. How would you build a sales forecast for a Unilever category? I would start with historical sales by product, customer, channel, and market, separating underlying volume, pricing, mix, and seasonality. I would then layer in distribution changes, promotional plans, innovation launches, competitor actions, market growth, and consumer income assumptions. I would create base, upside, and downside cases, document every assumption, and validate the forecast with sales and marketing teams. After launch, I would compare actuals with drivers, not just totals, and refresh the model regularly. Focus on historical trends, volume and price assumptions, seasonality, promotional calendars, distribution, market growth, competitor activity, macroeconomic factors, scenario analysis, and regular variance-based forecast updates. Question 6. How would you assess the profitability of a promotion? I would compare promoted sales with an evidence-based baseline to identify incremental volume, then calculate net revenue after discounts, customer terms, and trade spend. I would subtract incremental product, logistics, and variable costs to determine contribution profit. I would also test cannibalization within the portfolio, retailer funding, inventory loading, and post-promotion demand. A promotion can increase revenue while destroying value, so I would recommend it only when incremental contribution and strategic benefits justify the investment. While answering, cover incremental volume, baseline sales, promotional price, trade spend, cannibalization, retailer economics, variable costs, contribution margin, post-promotion effects, and return on investment versus alternative uses of funding. Question 7. What is working capital and how could Unilever improve it? Working capital measures cash tied up in receivables, inventory, and payables. I would monitor days sales outstanding, inventory days, and payable days, then calculate the cash conversion cycle. Unilever could improve it through better demand forecasting, lower slow-moving inventory, faster invoicing and collections, optimized payment terms, and supply chain collaboration. However, I would not pursue cash release blindly. Excessive inventory reduction can create stockouts, while extended supplier terms may damage resilience or relationships. Make sure to define receivables, inventory, and payables, explain the cash conversion cycle, identify FMCG-specific levers, and balance cash release against service levels, supplier relationships, and customer requirements. Question 8. How do foreign exchange movements affect Unilever's financial results? Foreign exchange affects Unilever through transaction exposure on foreign currency purchases or sales and translation exposure when overseas results are converted into the reporting currency. A weaker local currency may reduce reported revenue and profit even when local performance is stable. I would analyze reported growth alongside constant currency growth, identify currency-sensitive costs, and review hedging policies. I would also separate exchange effects from operational performance so management can make the right commercial decisions. In your answer, distinguish transaction and translation exposure, explain effects on revenue, costs, profit, and cash, and mention constant currency analysis, hedging, geographic diversification, and management interpretation. Question 9. How would you investigate an unfavorable variance to budget? I would first confirm the variance is real by checking data, timing, accounting treatment, and budget assumptions. Then I would decompose it into volume, price, mix, cost, currency, and one-off effects. I would speak with commercial and operational owners to identify the underlying cause, such as weaker demand, commodity inflation, or delayed shipments. Finally, I would quantify the full-year impact, propose actions, update the forecast, and communicate both the conclusion and remaining uncertainty clearly. Be sure to mention materiality, variance decomposition, data validation, volume price mix analysis, timing, operational root causes, stakeholder discussions, corrective actions, and transparent communication of uncertainty. Question 10. Which financial statements would you use to evaluate Unilever? I would use all three primary statements together. The income statement shows sales, margins, operating profit, and earnings. The balance sheet shows liquidity, debt, working capital, and invested assets, and the cash flow statement reconciles profit to cash generated. For Unilever, I would examine organic sales growth, operating margin, free cash flow, inventory, receivables, payables, and leverage. The connections matter. Profitable growth that consumes excessive working capital may not create cash or shareholder value. Focus on the income statement, balance sheet, and cash flow statement, explain how they connect, identify FMCG-relevant metrics, and show that accounting profit must be reconciled to cash generation and financial position. Question 11. What is the difference between reported growth and underlying sales growth? Reported growth reflects the change in published revenue, including currency translation, acquisitions, disposals, and other portfolio effects. Underlying sales growth aims to show comparable operating performance, commonly by excluding currency and significant portfolio movements while analyzing price and volume. I would use underlying growth to assess demand and commercial execution, but reported growth still matters for financial statements, investor returns, and cash generation. I would always clarify the company's exact metric definition before drawing conclusions. While answering, distinguish reported growth from underlying growth, explain exclusions such as currency and portfolio changes, discuss price and volume contributions, and note why both measures are useful for evaluating performance. Question 12. How would you evaluate whether a brand investment is creating value? I would evaluate both immediate economics and longer-term brand outcomes. The financial analysis would estimate incremental revenue attributable to the campaign, net of cannibalization, discounts, variable costs, and agency spend, producing incremental contribution and payback. I would also track market share, penetration, repeat purchase, awareness, and pricing power. Because attribution is difficult, I would use control markets, test and learn activity, and post-campaign analysis rather than claiming that every sales movement came from advertising. In your answer, discuss incremental sales, contribution margin, brand equity, market share, customer acquisition or retention, payback, attribution challenges, testing methods, and the balance between short-term returns and long-term brand health. Question 13. What is a three-way forecast and why is it useful? A three-way forecast links the income statement, balance sheet, and cash flow statement so operating assumptions flow consistently through the model. Sales and margins drive profit, working capital, capital expenditure, debt, and taxes affect the balance sheet and cash flow. I would build driver-based schedules, ensure the balance sheet balances, and test sensitivities such as lower volume or higher commodity costs. The model helps Unilever forecast liquidity, funding needs, covenant headroom, and the cash consequences of strategic choices. Make sure to explain the linked income statement, balance sheet, and cash flow forecast, key drivers, balance checks, scenario analysis, and how the model improves liquidity planning and decision-making. Question 14. How would you prioritize competing requests from senior stakeholders? I would clarify the decision each request supports, its deadline, financial materiality, and required level of precision. I would prioritize work that affects major commercial choices, external reporting, or immediate risks, while confirming lower priority deliverables can move. If requests conflict, I would explain the trade-offs and propose a practical sequence. I would also provide an initial directional answer when useful, followed by a deeper analysis without compromising data quality or clearly labeling assumptions. Focus on decision impact, urgency, materiality, deadlines, data availability, stakeholder alignment, and communicating trade-offs rather than simply accepting every request without challenging assumptions or quality standards. Question 15. Describe a time you used data to influence a business decision. In a university consulting project, I analyzed customer and transaction data to understand why a product line was missing its margin target. I separated price, volume, mix, and discount effects, then found that a heavily promoted low-margin segment was driving the shortfall. I recommended reducing that discount and reallocating activity toward a higher-margin bundle. The team accepted the proposal, and the modeled contribution improved materially. The experience taught me to present insights in decision-ready, non-technical language. Be sure to structure the example with situation, analysis, recommendation, stakeholder communication, and measurable result, emphasizing commercial insight rather than merely describing spreadsheet work. Question 16. How would you explain a complex financial analysis to a non-finance manager? I would begin with the business question and lead with the conclusion, not the spreadsheet structure. For example, I might say that profit is below plan mainly because volume declined in one channel while pricing partly offset the impact. I would use a simple bridge or chart, define any essential terms, and connect each driver to an action. I would then invite challenge, confirm understanding, and provide supporting detail for anyone who needs it. In your answer, mention starting with the business question, using plain language and visuals, focusing on decision-relevant drivers, avoiding unnecessary accounting jargon, checking understanding, and translating analysis into specific actions. Question 17. What controls are important in a financial reporting process? Important controls include appropriate segregation of duties, restricted system access, documented approvals, reconciliations, and independent review of material balances and journal entries. I would also expect standardized close procedures, variance analysis, master data controls, and clear evidence retained for audit. In a multinational business, consistent definitions and reporting calendars are particularly important. Good controls do more than prevent errors. They create reliable information quickly enough for management to act on emerging performance issues. While answering, cover segregation of duties, reconciliations, review controls, access restrictions, standardized evidence, variance analysis, master data governance, timeliness, and escalation of errors or unusual transactions. Question 18. How would you assess a capital expenditure proposal for a manufacturing site? I would assess the strategic need first, such as capacity expansion, automation, compliance, or cost reduction. Then I would model the initial investment, useful life, incremental revenue or savings, maintenance costs, taxes, working capital, and disposal value. I would evaluate NPV, and payback under base and downside cases, including implementation delays and volume risk. Finally, I would recommend approval only if returns exceed the hurdle rate and operational owners have a credible delivery plan. Make sure to cover strategic rationale, upfront investment, incremental cash flows, operating savings, capacity, maintenance, working capital, NPV, payback risks, sensitivities, and post-investment review. Question 19. What would you do if a senior manager challenged your analysis? I would listen carefully and identify whether the challenge concerns data, methodology, assumptions, or interpretation. I would revisit the source information, reproduce the calculation, and discuss the business context with relevant stakeholders. If I found an error, I would correct it promptly and explain the impact. If the disagreement remained judgmental, I would show alternative scenarios and sensitivities. My goal would be a transparent, evidence-based conclusion, not defending a spreadsheet simply because I created it. Focus on listening carefully, testing assumptions, distinguishing factual errors from judgment differences, validating data, remaining professional, revising when appropriate, and escalating material unresolved issues with evidence. Question 20. What would make you an effective financial analyst at Unilever? I would bring strong attention to detail without losing sight of the commercial decision behind the numbers. I am comfortable analyzing data, building forecasts, investigating variances, and explaining conclusions clearly to different audiences. I also value constructive challenge because finance should improve decisions rather than merely record them. At Unilever, I would combine curiosity about consumers and brands with disciplined control, reliable delivery, and collaboration across markets and functions. Be sure to combine technical accuracy, commercial curiosity, communication, ownership, ethical judgment, collaboration, adaptability, and the ability to convert analysis into practical recommendations across a complex global organization. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.